Okay, so I might be the first person to tell you this, but now it's time for you to stop doing the rent-to-own thing and start trying to get your own home. For over 10 years, I've specialized specifically in helping people to get approved for a home of their own. I've helped this family and this family and this family and plenty more. Today I'm going to show you why you need to stop doing those rent-to-own programs and how your SAT can actually help you get a home of your own. Now the problem is most people go to the rent-to-own option because they really feel like this is the only option that they have to ever become a homeowner. But what they're not thinking about is how it can be extra costly versus trying to do it any other way. So first off, let's talk about the difference between a rent-to-own, which is a lease purchase, and a lease option. So with the rent-to-own, basically you're saying, okay, I'm going to rent for this specified amount of time, and then at the end of the specified amount of time, I am going to purchase this home. Now when it comes to a lease option, that's a little bit different. You're saying, of course, still for this specified amount of time, I'm going to lease the home, and then I want the option to be able to purchase this home at the end of that term. So you're probably wondering, okay, that's the difference, but how does that really affect me? So let me start with the biggest way that it affects you. Usually when you start this type of agreement, you're putting down some large lump sum of money at the beginning of this transaction. And now that can range depending on who you're working with, your landlord, and if they're working with a company or not. It can be anywhere between 2 to 7% of the total determined value of the home. Now that can equate to a lot of money, especially depending on the total value of that home. And if you did the rent to buy option, a lot of times the terms in those agreements are gonna say that you lose out on all of that money that you paid up front if you end up not purchasing the home at the agreed time of that term. Now, even though you can obviously tell what the problem is with that part, you can also look at the problem and see how it's bigger, because you could have paid that same amount in closing costs or in down payment for a home that you're going to own without paying all these extra costs out of pocket, versus using that money on a lease option, which you might actually lose out on your money. Now another problem is you might end up paying more for the rent that you would have on this agreement than you would have had to pay for rent if you were in a regular lease agreement without the option to buy. Now a lot of times this equates to them saying, you're paying extra money monthly and it's going to go towards the principal when you actually get to the part of actually trying to purchase the home. But again, if you end up getting to the point where you're unable to purchase the home, then you're going to end up forfeiting some of that money that you put, or you're really going to look at the extra amount that you paid every month really doesn't equate to much as far as knocking down the principal that you would owe at the end of that term. And just so that you know, in case you're unfamiliar with what's going to be the big difference when the term is up, more than likely what the situation is going to look like is you have to actually go get approved for a loan to purchase this home from the landlord or the person that's leasing it to you. So it's not that they're going to continue to finance and receive payments from you. They want to get that actual lump sum of money for the home at the end of the term. And the only way to do that is for you to have your credit in a place where you were approved to go ahead and get a large lump sum of money and pay them off. Now, another problem that is likely to occur, especially with the way that things have been changing as far as home values over the period of time that we've been dealing with lately, that the value of the home might not be what it was at the time when you actually are in a point where this term has ended and it's time for you to purchase the home. So you could be on the hook for, based on your agreement, paying a lot more for the home than it's actually worth. And then of course, that means that you're going to be overpaying for something if you are in a position to go ahead and try to get it. And that can also bring challenges, because trying to get a bank to give you a large lump sum of money for a home that isn't even worth the value that you owe on paper, which can end up in a problem with the agreement going forward and you losing out on money as well. Now, with this next thing I'm going to tell you, I'm going to go ahead and assume that most landlords out there are going to be operating in good faith and that they are going to have the best intentions and hoping that you do get to a better place with your credit so that you can actually be able to purchase the home from them. But there are a lot of landlords out there that do these rent to own or lease options because they know more than likely you're probably not going to end up doing anything on your credit, because they know, like you and me both know, a lot of people, when it comes to credit, they end up procrastinating on getting anything done with it, and they end up biding their time until it's too late and they need their credit for something, and then they expect something magical to happen overnight or within 30 to 60 days, and they expect their credit to be better overnight just because they need it, not looking at how long it actually takes to improve one's credit. And because they know most people are going to procrastinate and they're not going to do anything that they should be doing during this time of that lease until it's time to purchase the home, then they know that they're going to get extra money from you by the money that you paid up front, the extra money that you're paying monthly, and then as soon as you don't have the money or the credit to actually buy the home from them, they're ready to go ahead and enforce the agreement, keep your money that you've paid, and in some instances put you out of the house, put somebody else in the house, and then do the same thing with another person. Now, I pray that none of you are in that situation, but a lot of times that's what happens. So look, if you're finally in that position, in that mindset, that you are actually ready to try to get a home of your own, then it's time for you to start working on your SAT. Now, if you think you know what SAT stands for, I want you to go ahead and pause this video and write down what you think the acronym SAT stands for down in the comments. And please make sure that you don't cheat. Pause the video, write it down in the comments, and see if you get it right as I explain what it is. Also, if you've been getting value from this video so far, make sure that you hit the thumbs up to like this video so you too can show it to more people, and subscribe to the channel so you can get more information just like this. Now, the S stands for score. Now, this is something that most people put the most importance on, but it's actually not the most important thing. While you do have to have a certain number to get approved with most lenders. And the reason why I'm saying it's not the most important is because there is something else that determines what the score is. So we have to focus on what determines what the score is, the roots versus worrying about the weeds, and then we can get our score to where we need it to be. But again, the fact does remain that when you go to the lender, the mortgage lender, they're going to actually pull all three of your credit reports from Experian, Equifax, and TransUnion, and they're going to want to see what all three scores are, and then they're going to go with your middle score, meaning not which one is like physically positioned in the middle, but which number is in the middle. So not the highest, not the lowest, that number that's right there in the middle. Now, the number that I tell most people to get to as a minimal, even though some mortgage lenders might say they can accept lower than this, to make sure that you don't have a whole bunch of extra costs that come with having a lower score, you want to at least have a FICO score, at least two of your FICO scores on two of the bureaus at a 640 or higher. Now, it's important to make sure that you get your FICO scores. Credit Karma does not give you a FICO score, and when you go to most of the bureaus websites, you're not getting a FICO score either. So you have to find a place where you can get your actual FICO score. My FICO can be a little bit more expensive than other options, but I do have a cheaper option to get your FICO score down in the description, and it's called My Score IQ. Now, anyway, once you've seen your FICO scores, what's going to be important to know is that there's still going to be some variances in scores. Like when they pull your score for a mortgage, they are going to pull an older version of your credit score that they use for mortgages currently. But either way, having a FICO score is going to give you the closest thing to what you're going to see when you go in that office. And having a 640 is because in most instances, a lot of them at the floor, to be in a decent place, having like a 620 middle score is going to be what's going to be ideal to get you approved. So having a 640 is going to put you in a position where you more than likely are close in range to what you need to have, even if there are some differences in the score calculation. Okay, so now let's talk about the A, and the A is for accounts. And of course, these are the accounts that are reported on your credit report, and they can make it challenging and give you extra hurdles to jump through, even if you have a 700 credit score. That's right, I have seen a person with a 700 credit score get denied for a home, and it was because of the accounts on their credit report. Another thing that I've seen to happen is a person with recent late payments on their credit report, and recent as far as credit can be anything within the last 2 years, but very importantly, the last 12 months. But what I've seen happen is if you have those late payments, it can cause a mortgage lender to make you have to have reserves. And a reserve means that, let's say that they say you can afford a monthly mortgage payment of $1,500. Well, if you have recent late payments, they're not sure if you're really going to be paying them on time because you haven't been paying other people on time recently. So they would want to see that you have $1,500 saved up in your bank account. But the thing is, usually it's not just going to be 1 month of mortgage payment. It might be 2 or 3. So that means you might have to have $3,000 to $4,500 in the bank account, showing that you just have that money sitting there in order for them to feel comfortable moving forward with you, regardless of what your credit score is. So that's one way that it can make it harder for you in regards to getting a house. Now, in regards to the accounts and items on your credit report, the first thing people try to worry about is those inquiries. I'm going to tell you now, just don't focus on the inquiries at all. Usually, you're going to get the lowest impact to your credit score by trying to get them removed, if you're even successful in getting them removed. A lot of times, your inquiries are older than a year, and if they are, they're not even counted against your score, and most lenders aren't going to hold them against you if you haven't had an inquiry within a year. And if you know that you have a year before you try to buy a house, or 6 months or so, stop applying for stuff, and then you won't have any recent inquiries, and it won't affect you in the process. Even if you've gotten inquiries from a car dealership or something like that, just know that if you got 100 inquiries and they were all within the 30-day period, they're going to count them all as one in your credit score, so you don't have to worry about that, thinking that that's going to hurt you either. Now, one thing that you want to pay attention to on your credit report are going to be your collections and your charge-offs. Now, the collections and charge-offs are going to usually be one of the things that are going to affect your score the most in regards to holding your score back, and these are items that you actually do want to focus on and deal with on your credit report. Now, the way that most people try to deal with these things is by trying to pay them off, and paying them off can actually do more damage and bring your score down further and cause it to take longer to get you to that score threshold that you need to be. And if you didn't know, they don't have to remove those items, collections and charge-offs, off of your credit just because you paid it. There is no law that says that they have to do this. There are other means that you have to go about to try to get these items removed from your credit, which is the thing that will actually help to improve your credit score. So what you should be doing is disputing these accounts. Now, you don't want to dispute on Credit Karma, on the Bureau's websites. Doing it online limits your options and take away some of your rights that you have. You always want to dispute by mail, because that is going to be the best option that you have to get results as far as disputing. Now, for those of you that have been out there trying to dispute on your own, maybe you don't have a lot of time on hand, maybe you have a big family, maybe you work multiple jobs, and you just don't have the time to keep up with writing letters, sending out disputes and all of that stuff, then you can go down to the description. We're actually having a promotion right now, and you can try to get on and get some services from us. We only take a limited number of people in a month, so if we have some space for you, we can try to take you on as a customer and actually help you. And if not, if we don't have space, or if you don't want to do that, you want to try to do it yourself, we do have some options down in the description as well, which are free or very low cost, and they can help you to get the direction you need to get better results from what you're doing versus that free information that you've been looking at in other places that you just found on Google. But let me go ahead and jump into the T so you can know what that stands for too. Now, the T is actually in the middle of an acronym, which is DTI, your debt to income ratio. This is another important factor in you getting approved. If your DTI, which is a determinant of how much you can actually afford for a mortgage, if your DTI doesn't meet a certain threshold, you can actually get denied. Even if you have a clean credit report, even if you have a good credit score, if you can't actually afford a home based off the numbers, then they're not going to give it to you either. But it can also get you a lot smaller home or a lower value home compared to what you're really trying to get or what you need for your family. Now, this number is based on the monthly payments that show up on your credit report for the accounts that are reporting on your credit report. So if you have a credit card, if you have a car loan, if you have a personal loan, if you have anything like that reporting on your credit report, that monthly payment that shows up on there is going to be what they use in that calculation in relationship to your monthly income. So they're not going to look at your utility bills. They're not going to look at, some of the other things that you have. They're looking at your credit-based monthly payments. Now, there is a word of warning I have to give to you guys out there that are using Experian Boost, or that are reporting, your utilities and your Netflix account on your credit report, and some of you that even have rent reporting accounts. While these things can help you build payment history, one of the things that you don't think about and that you're not really told is that some of these accounts, the way that they're reported, is going to add a payment amount on your credit report, and these things are things that wouldn't normally be on your credit, like your utility bills, your electric bills and stuff like that. So if you have your rent being reported and it's being reported as a payment amount, and let's say your rent is $2,000, well, now you have $2,000 reported as a payment, which can dramatically increase your DTI and knock you out of the water as far as trying to actually get a home, because now it looks like you have too much debts that you're paying. And also your utility bills and stuff like that, your phone bill being added to your credit report, depending on how they report it, can do the same thing. So even though you might be doing something like an Experian Boost to try to help you, you can actually end up hurting yourself, and most people don't even know that this can happen. Now look, if you are focused on trying to get some action happening with your SAT and trying to get it in a better place to help to improve your credit, I'm going to send you to the next video, which is going to actually help you and give you more in-depth detail on what you can do as far as disputing to try to get your credit to a better place so you can stop doing the rent to own and start moving towards getting your own home. Thank you for your time here, and I'll see you in the next video.